Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Welcome to the first installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video for the third quarter of 2024. The first video for the third quarter. Feels weird to say that, but here we are in July. As we discussed, and we looked at the numbers last week, we are halfway through the year, and now let's see if the markets can match what they did in the first half of 2023. Again, go back to last week's video. You'll see exactly how they did over that period of time. One thing that is probably needed to continue the momentum for the next quarter, got to be earnings growth. Remember, when you buy a share of stock, you are buying ownership in that company. You are buying a right to all their equipment, all their inventory, all their assets, and most importantly, their ability to generate earnings into the future. So are we going to see those earnings next quarter? Are we going to see them go up? Or are we going to see them go down? Well, that's always the age-old question. But as of today, we are looking to possibly post our best quarter for earnings growth around 8.8% year over year. So that's looking at the third quarter last year, since the first quarter of 2022, right before everything fell apart because of 9% inflation and massively increased Fed putting interest rates up, as well as earnings declines happening those next few quarters. Now, next week, we'll get into earnings of the major banks like JP Morgan, which is a call that I always listen to each and every quarter, considering they are now the largest bank in the United States. But we'll also hear earnings this coming week from Citigroup, Delta Airlines, Pepsi, and Conagra. The expectation is that the S&P 500 companies are going to increase their earnings 11% cumulatively for 2024, according to FactSet. The expectation is this will be led by the communication services sector, and FactSet thinks they'll rise by about 18% because of companies such as Google and Meta, which are incorporated in the communication services sector. The next highest sector, healthcare, 17%, at least according to FactSet and their expectations going forward. Now, as we looked at last week, though, tech and utilities led the way last quarter. And that may be a potential issue for the market because there's a high correlation in the S&P 500 with the top 10 companies accounting for about 37% of the market capitalization, but only 24% of its earnings, which is the widest gap we've seen since 1990, according to Apollo Global Management. So we have reason to be bullish, and we are pricing in that bullishness. But if all that concentration means if the bullishness doesn't pay off, we could see a little bit of a pullback. And that is why the Dave Ramsey approach to investing of only having about half of your companies in the S&P 500 names, growth and income, and coincidentally only 25% in those high concentration names, growth, and then balance that with aggressive growth, which is a very inexpensive part of the market, and international, another very inexpensive part of the market, is probably the optimal way to go going forward and long term. Additionally, it's why we love, even despite its recent underperformance, a moat-based approach, MOAT-based approach to investing in the S&P 500, which gives a lot of weight to sustainable competitive advantage, is the moat there, and equal weighting, so no concentration risk, and a high value on valuation. So with all that, let's continue on our weekly roundup of economic data we look at each and every week. First, each week we look and review the Atlanta Fed's GDP Now report to gauge in real time how fast our economy is growing. We're at the end of the quarter now, past the end of the quarter. And so as we continue to get pieces of data from the month of June, the last month, the last quarter, this is the point where the number starts to have a very low probability of error to the actual number that will be reported. As we learned last quarter, we discussed last week, we had a pretty nice size dispersion between what the Atlanta Fed was thinking and what the actual number came in at. So it's not 100% accurate, but most quarters, the closer we get to the actual report coming up in a few weeks here in July, the more accurate the number is. This week, the Atlanta Fed's number came in at 1.5%, 1.5%, which was another drop. So we've dropped 2 weeks now. Last week, we were around 2.2%, if you remember. Next, each week we look at the initial claims for unemployment insurance for a gauge into front-end problems in the labor market. The Fed gets this report, as we all do each and every week, so they can have high-frequency data as it relates to employment. This week, the number came in at 238,000, which is right in line with the one-year average. And next, for 2024, we're also watching mortgage rates. We want to watch mortgage rates because we want to see how home affordability is doing. We think without price decreases, you're only going to see that through lower mortgage rates. This week, the rates climbed a bit, 6.95 for the 30-year mortgage and 6.25% for the 15-year mortgage. And finally, let's check out how we ended the first week of the quarter on the markets. This week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, that was positive 1.94%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 1%. And yes, it was negative 1%. And the MSCI EFA, which tracks international stocks of developed markets across the globe, excluding the US, of course, that was positive 2.25% for the week. A lot of election data coming out of Europe, and that helped their markets. So international comes out fast in the quarter and won the first week of the quarter. How about point number 2? Let's discuss the amount of open jobs out there today, amount of jobs that are unfilled. The U.S. Bureau of Labor Statistics, the BLS, they reported that job openings remained relatively steady at 8.1 million on the last business day of May of 2024. This figure represents a decrease of about 1.2 million job openings compared to the previous year. The job openings rate remained largely unchanged at 4.9% in May, and the uptick in job postings in May's JOLTS report reflected a significant milestone for the U.S. labor market. The ratio of job openings to unemployed individuals dropped to 1.22 available jobs per job seeker, mirroring the level observed in February of 2020. Big news there, that was right before the pandemic. While the overall number of job openings remained relatively stable, some industries experienced notable fluctuations. Job openings declined in accommodation and food services, down 147,000, and private educational services, down 34,000. Conversely, job openings increased in state and local government, excluding educations, durable goods manufacturing, and the federal government. Again, government leading jobs. Ugh. May witnessed little change in both the number of quits, so people take your job and shove it, 3.5 million was the number of quits, and layoffs and discharges, which was about 1.7 million. The quits rate, considered an indicator of workers' willingness or ability to change jobs, remained at 2.2% in May for the 7th consecutive month. And that indicates that more employees are holding on to their jobs, possibly due to the fact that there's a little bit of uncertainty in the labor markets and not so many jobs open. Again, 1.22 jobs. The layoffs and discharges rate remained relatively unchanged at 1%. And we believe that the labor market is demonstrating resilience. The sustained job growth throughout the year suggests that consumer spending power will likely increase. And remember, consumer spending is 2/3 of our economy, so that continues to contribute to economic expansion. How about point number 3? Do you want to know a little bit about the jobs number we just received on Friday, July 5th? Well, the U.S. labor market exhibited signs of moderation in June of 2024, because that's what the July number was for June 2024. And this was all coming, again, from the Bureau of Labor Statistics. Non-farm payroll employment increased by 206,000 jobs, as you can see on your screen, slightly surpassing the street's expectations. They were only expecting about 190,000 new jobs. However, this gain was accompanied by a rise in the unemployment rate at 4.1%. That marks a 0.4 increase from the bottom, its highest level since November of 2021. The increase in unemployment stemmed from a surge in labor force participation, suggesting that more individuals were actively seeking employment. Average hourly earnings as well was reported out, and that grew by a modest 0.3%, pushing the annual wage growth rate down to 3.9%, the lowest level in 3 years, but I should mention still higher than the CPI number. The June jobs report revealed a downward revision of 111,000 jobs for the combined employment figures of April and May. So the numbers we got back in April and May revised down about 100,000. This adjustment, along with the uptick in unemployment and cooling wage growth, points to a softening, not a bad, but a softening labor market in the second quarter. As we discussed, in the point above, government employment emerged as a significant contributor to job creation in June, accounting for over a third of the total gains. And we just don't like that. Health and social assistance and construction also experienced notable job growth. Now, we are closely observing trends in labor force participation and the unemployment rates to gauge the health of the labor market. And the recent increase in the labor force participation rate, these are folks that are participating in the labor market, hence labor force participation rate, and particularly those that are in the participation rate among prime age workers, which are those between 25 and 54, that reached a 22-year high, indicating a willingness amongst individuals to re-enter the workforce. However, as mentioned above, we express caution regarding the sustainability of government-driven job growth and emphasize the importance of private sector employment for a robust economic recovery, expansion, and continuation. The future trajectory of the labor market will depend on factors such as consumer spending, what happens with inflation, and the Fed's policy decisions around interest rates. And that interest rate next meeting is coming up this next week. The June employment report carries significant implications for the Federal Reserve's monetary policy outlook. The moderation in hiring, coupled with easing inflation, the inflation numbers have been so much better the last 2 months, strengthens the case for the Fed to initiate interest rate cuts in the coming months. While the July meeting might be premature for a rate cut because it's so close, a subdued inflation report in the following weeks could sway Fed officials towards a September reduction. And that's what the CME group, who we looked at a couple times on this video series, is estimating high probability, about 75%, that we cut rates in September. And finally, point number 4, let's see how the manufacturing sector of our economy is faring. Well, how do we do that? Well, there's a report that comes out. It's called the ISM Manufacturing PMI. Now, this is a key indicator of the health of U.S. manufacturing sector. Granted, the manufacturing sector is becoming a smaller and smaller part of the overall U.S. economy, but in June, the number fell 48.5, making the third consecutive month of contraction. Anything under 50, contraction. This decline, which was below the market expectations of 49.1, signals continued weakness in the manufacturing activity due to subdued demand and a reluctance amongst businesses to invest in capital and in inventory. The drop in the PMI was widespread across various sub-indices, with production and employment contracting, while new orders shrank at a slower pace compared to the previous month. However, there were some positive takeaways from this report as we received it, including a significant decrease in price pressures, inflation, with the price paid index reaching its lowest level since December of 2023. So there's just another indicator that inflation is cooling. Now, several factors contributed to the ongoing weakness in the manufacturing sector. In previous videos, we've talked about how high interest rates implemented by the Federal Reserve, and of course they do that because they're trying to deal with their two mandates, combating inflation while keeping a strong labor market. And so high interest rates combats inflation, but that has dampened the demand for goods. Manufacturers cited this monetary policy along with other economic uncertainty as reasons for their hesitancy to invest in capital and inventory. Additionally, softening demand for goods, partly due to consumers shifting spending towards services, less on goods, which again, manufacturing is heavy goods, has also weighed on manufacturing activity. Despite these challenges, some industries within the sector, such as primary metals and chemical products, they actually did report growth on the June 2024 manufacturing PMI report. Commentary from manufacturers painted a mixed picture, with some expressing optimism about customer orders, while others highlighted concerns about weak demand and declining sales backlogs. Chemical product manufacturers reported a high volume of customer orders, while transportation equipment manufacturers noted that consumers continue to cut orders with very short notice. The divergence in experiences suggests that the manufacturing slowdown is not uniform across the entire manufacturing sector. However, some manufacturers, in particular those in the industries facing weaker demand, have reported to measures like they've furloughed employees and reduced inventory levels to adjust to what is a challenging environment for them, while others are still status quo, doing very well. While the manufacturing sector does face headwinds, the overall labor market remains relatively robust. The ISM survey's employment index, which is part of all this, dipped in June of 2024, But other data indicates that the labor market is gradually cooling rather than contracting very, very sharply. And that's what you want. That's what we call gradually cooling. Another way to say that, a word you hear us talk much about on this video series, which is a soft landing. Here's to a soft landing on the economy. Now, hopefully this video was helpful to you. If it was, could you do us a favor? You can do us a favor by hitting the like button and the subscribe button. The like button helps push our content out to more people on YouTube and Rumble. The subscribe button allows our content to be pushed out to you as we release it. As well as if you'd like to meet with any of our financial coaches or our financial planners. Our financial coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt free. And our financial planners help you in baby steps 4, 5, 6, so you can eventually get to baby step 7, where you can live and give like no one else. They'll help you with retirement planning, college planning, as well as a plan to pay off that house and be completely, I'm debt free. So thanks so much for watching this week's video. We'll look forward to seeing you next week.